Morning, everyone. Many thanks for joining us for this morning's webinar hosted by Clarkslegal, Forbury Investment Network, and Quantuma. My name is Zafar Kanani. I'm a manager at the Forbury Investment Network, and I am delighted to be your chair today. Today's webinar is the third in a series where we've been exploring various funding and financing options throughout the business lifecycle. Our first two webinars focused on angel investing and venture capital investing in the context of Series A++. If you didn't get a chance to catch those or join us for those, do head over to the Clarkslegal website where you can gain access. Today, we are moving much further along into the business life cycle and are going to be looking at the topic of selling your business. We're joined by two esteemed experts who are going to show us some interesting insights and nuggets of information in relation to the topic. The first is Stuart Mullins, who's a corporate partner at Clarkslegal. Stuart provides advice and support on all aspects of corporate and business law, from startups to owner-managed businesses and international clients across a range of sectors. Stuart's going to talk us through the legal process of selling your business, including due diligence, legal documentation, and of course the all-important post-completion considerations. We're also joined by Adrian Howells, who's a corporate finance director at Quantuma. Adrian specializes in advising private businesses on raising capital facilities in the 2 to 25 million range, and also advises shareholders on exiting their businesses. Adrian's going to talk us through the various methods of exit, from private equity to trade sale and employee ownership trusts. He's also going to talk us through some of the tax implications that one should consider when looking to sell their business. Before we kick off, just a couple of housekeeping points. We're of course delighted to take your questions, but we will do so after Adrian's and Stuart's presentations. So if you do have any burning questions throughout either of their presentations, do use the chat function that's available to you, and I will make sure that your questions are directed as appropriate to one of our experts. So without further ado, over to you, Stuart.
Thank you, Zafar. Thank you everybody for joining us today. I hope you will benefit from the whistle-stop tour that we will provide in this overview. So the first thing to consider is the general overview, really. As you'll see there are 4 points that really any transaction, whether it's a share sale or asset sale, will generally follow in terms of legal process. I think the first thing to mention are the importance of non-disclosure or confidentiality agreements. I mean, when you start having discussions with any purchaser, you are going to have to, through due diligence, provide them access to sensitive commercial information. And the only way to protect yourself through that is through a non-disclosure agreement. Now, word to the wise, it's important to take advice on the detail of what you're trying to protect and what is confidential information, because any attempt to include within that non-disclosure agreement information which is in the public domain is likely to cause a problem in terms of enforceability of that agreement. We'll then look at due diligence and an overview. What is it? Some practical tips based on my experience to bear in mind when embracing that process. We'll then look at some of the legal documentation, and I'll give you some tips on those things, and then to wrap up the post-completion element, which people tend to forget because the excitement of the transaction is done, but nevertheless that's very important to dot the I's and cross the T's following completion. So moving on, due diligence. So what is it? Well, it's is what it says on the tin. It's a set of detailed analysis and inquiries that will be raised by any buyer that will look at the company from all angles, from financial and accounting. It will look at the operating performance of the business, material contracts, customer contracts. It will ask about employees, governance, property. The key thing to bear in mind with regards to due diligence is to start the process as early as possible. And if you're thinking of getting involved in a sale process in 6 to 12 months, it's never a bad idea to start looking critically at your business and ascertain where there might be issues or shortfalls in terms of completing contracts, or where there's issues or gaps in governance and filings that companies has. Get yourself in the best possible shape so that when you're not under the time pressures of a completion or a transaction deadline, then you give yourself some time. Embrace it positively. It is very difficult. Make sure you've got a good team of people around you, because you must get on with the day job. You must continue to run your business, and you need to answer these replies fully and systematically. So moving on, we'll just look at the key areas that generally flag. As I say, incorporation and share structures. Quite often, any buyer will look at the company record and tie that up with the information that you provide. If there's any errant filings or there's any gaps in filing history, we can generally assist to deal with those before they become an issue. Make sure that your business plans, budgets and forecasts are as up to date as they possibly can be. That will have an impact and bearing on the financial due diligence. And make sure the articles of association that you believe to be the true ones are filed at Companies House, and resolutions necessary to adopt those have been filed. Be clear as to the terms of any shareholders agreements and any potential issues or rights in relation to preemption that you might need to flag and start talking to minority shareholders about is particularly key. And then continuing on from that, questions will be raised about intellectual property ownership and protection. So make sure that the domain names and the trademarks that you paid for years ago are vested in the company that's being sold, and any intellectual property deeds of assignment are dated and in force. Make sure that your employment contracts, staff handbooks are all up to date. Be certain that your management team and senior employees are under contract, under current contracts. Hopefully have suitable restrictive covenant clauses and anti-competition or non-compete clauses built into those. Be clear in terms of the commercial contracts that you have, that you understand the impact of any perhaps change of control clauses that may give rise to a sale. Understand your liabilities, your banking obligations and indebtedness. Make sure that you've released yourself from any historic personal guarantees. They don't necessarily fall away simply because you sell your business. And be clear on terms of the assets that you own, the assets that you lease, and the assets that you think you own. Ensure that they do indeed vest in the selling company rather than in perhaps another company that doesn't necessarily form part of the group and the target. And the reason, and I'll come on to this again, is why you have an interest in being systematic and thorough, is that any buyer can look at gaps or issues at DD stage which may impact the ultimate price that you get for your company. And further, the relationship between due diligence and disclosure is very important. And disclosures are one of the processes or systems that we have that will protect you under the warranties and indemnities. So moving on, we'll now look at the next step in the process, which will be looking at the purchase agreements and articles of association. Quite often, when you sell the company, rights for the benefit of any minority shareholders or provisions relating to deferred elements of the transaction will coexist in new articles. We'll talk about disclosure, as I've alluded to earlier, and we'll give you an overview of how disclosure works and the supporting documentation that's needed to support the disclosure letter itself. So in terms of the purchase agreement, moving on to the next slide, the purchase agreement itself, and whether it's an asset sale agreement or a share sale agreement, generally follows a standard format. And that format is this: that the agreement will begin by reciting the parties, and it will then deal with how the payment of consideration is discharged. Quite often, an element of consideration will be deferred and contingent upon financial and material performance of the business remaining so or increasing over a period of time. One of the things to consider if you do have deferred consideration is how you safeguard that. So if, for example, an element of the consideration is deferred for a year or two, what protections have you thought about or built into the purchase agreement in the event that the company itself is wound up or hived up as part of a reorganisation? You could end up with a contractual entitlement to defer consideration against a defunct company or a company with no money in it. So considering how you protect yourself with guarantees in respect of the buyer's larger group, or considering whether or not the board of the buyer should give personal guarantees to discharge that consideration is important. And then the bulk of the agreement is made up of warranties and representations. And those warranties and representations are statements of fact. They are representations that the employees of the company have all done everything they need to do under the contract. There's never been a grievance, that the lease has always been complied with in respect of property. It will include things along the lines that all material customers will not leave the company or pay within the statutory or the contractual prescribed payment terms of the customer contract. And if for any reason you're unable to warrant each and any one of those, we need to go through a disclosure process to protect you, because the assumption is that the company is 100% compliant in terms of governance and everybody does what they say they're going to do under the contracts with customers, employers and suppliers, and that's very rarely the case. And if any of those facts as a matter of course are not true or correct, that can give rise to a breach of contract claim or a misrepresentation, and the buyer is then able to sue the sellers for recovery in respect of any losses. If we move on to the next slide, there will also be requirements, as I say, in terms of warranties about share capital, governance, finance, intellectual property. The agreement may also contain indemnities over and above those warranties and representations. Now, we have to be careful with indemnities, because you shouldn't provide an indemnity in respect of anything that isn't specific and isn't highlighted as a particular issue. And the reason for this is the recovery of any seller, of any buyer. If a pen is warranted for a specific purpose and it costs £100, and I sell that to Adrian, and Adrian is not able to use that pen for a specific purpose, but is able to or could mitigate his loss by selling it to Zafar for £50, under a breach of contract, my liability is principally £50 to Adrian, irrespective of whether or not he has sold that pen on to Zafar. It's whether or not he could have. He has a duty to mitigate his loss. If I indemnify the use of the pen for £100, Adrian's under no obligation to sell that pen on to Zafar to mitigate his loss. He will claim from me under an indemnity the cost of enforcing the indemnity, the £100, and he will be entitled to keep that pen. So I hope I've illustrated there the real difference between an indemnity and a breach of warranty or representation claim in terms of what you can recover for and how that could impact you as a seller and any potential liability after completion. The agreement moving on will contain restrictive covenants in respect of the sellers, and that's really important. They're generally quite onerous, and whether or not they're a consideration depends on how you sit on a sale. If you're going to retire and never work again, they're generally not an issue. But if you're going to pursue other interests or perhaps have other ventures, it's really important to understand how they will apply or potentially inhibit you later down the line, and therefore be open and honest and clear and transparent with the buyer at a very early stage to explain what you plan to do for the next 2 or 3 years from completion. And then moving on, the disclosure letter. So under the SPA or sale contract, it's we've gone through the warranty process, and we can build in limitations in respect of an ability to sue under a warranty or representation around time limits or de minimis amounts, i.e. that liability has to exceed a certain amount before we can pursue a seller. If there are issues in respect of the statements of fact, the disclosure letter is a particularly helpful tool. It begins by setting out some general disclosures that a buyer should be aware of anything that's on the company register, or they should take out appropriate searches of places like the land registry to identify if there's any restrictions that may inhibit the leasehold or freehold property that's coming as part of the deal. But then the bulk of the disclosure letter is made up by qualifying each of the warranties in turn. So for example, if there's a warranty that the company hasn't been sued in the last 3 years, you would against that particular warranty give a narrative, the fact that there may have been a claim 12 months ago that you believe it's been resolved, that the deal has been settled, and therefore you would reference that with information in a disclosure bundle, which is in a virtual data room these days, giving details. And if you do those things, you can't be pursued for a breach of warranty and representation. So it's a very important process to protect you as a seller. And then rounding off on the next slide, as I say, it's important to make sure that you don't just forget about all the other bits and pieces that sit in page 80 of the share purchase agreement, and ensure that you have a clearer understanding of all the post-completion obligations that you might need to discharge. So for example, it may well be that if you haven't managed to transfer a certain domain name, that you will do that within a period of time. There will also be obligations to file information relating to the sale at Companies House, and the sellers and the buyer should work together to make sure all those elements are done, including perhaps your resignation as a seller director from Companies House if that's going to take place. And it's really important to ensure that the company registers, so the registers of members and transfers, for example, are correctly written up on completion and handed over. So thank you for listening. That was my whistle-stop tour of the sale process, and I'll hand you over to Adrian, who will give you a much more interesting presentation, I'm sure, about the practicalities, advice and guidance from a corporate finance aspect. So Adrian, over to you.
That's an optimistic introduction. Thank you. Thank you, Stuart. Thank you, Zafar. It's a pleasure to join you guys this morning. Good morning, everyone. Thank you for joining us. Yes, I'm just going to give a few sort of practical pointers around how to actually get a business sold. So my first slide, there's 3 key bits that I want to talk to you about this morning. How we would break down thinking about selling a business. So planning and preparation, the first one, so around timing, looking to present the company in its best light, and corporatizing, and I apologize, I don't think that's a real word, but corporatizing the business. I'm going to talk to you about routes to market. So trade, private equity and employee ownership trusts are the main 3. Look at the pros and cons for each of those. And then finally the sale process itself, which I've broken down into 3 key stages: marketing, diligence and completion. Overriding all of these though is, the mantra around that this is smoother if you can get better advice and early on. All of these stages work better with good advice. I'm going to talk also briefly about helping you choose the right advisor. So moving quickly on to planning and preparation. So timing, what I mean here is actually timing before getting into a process. To get ready to go to market. And actually, that's the more prepared you are, the better your outcome is likely to be. And actually, most owners will have a bit of a view, probably 10 years down the line in terms of, well, one day I'll exit. But actually, in terms of properly sitting down, starting to plan and prepare, between 6 months and 2 years, sounds like a long time, doesn't it? But actually, will stand you in good stead once you get going. In terms of presenting the company in the best light, there's a few things to think about here. Quality of earnings is quite key, and by this, there's a few things you can do to improve the quality of earnings in your company during the preparation period. So if you're in manufacturing engineering, you might seek to renew a long-term agreement with a key customer. If you're in software, you might look to move from licensing to SaaS. Although that's quite an expensive and lengthy process, the multiples that buyers will pay for SaaS businesses are far in excess of what they'll pay for licensing type businesses. Also, particularly if you're a slightly smaller business, you might rely on one or two very large customers. So you might want to spend some of that planning and preparation time just looking to diversify the customer base a little bit, so that the quality of earnings, which is something all buyers look to, will be that bit more appealing to them. So commercial decisions, so that might be looking at your spending decisions. So a good example here might be investing in the sales team. Now, depending on when you're looking to sell, you need to think when making such decisions, will I have got a payback before selling? Because obviously if you increase your sales staff, they're not going to yield you any revenue initially. So actually there are costs, there are a drain on the profit. Now, if you're going to get quite a quick return from your sales team, then maybe it is worth investing earlier on and during this preparation process, so that your profits are that bit higher once we actually go to market. If actually you're in a sector where the sales team take a year or two to really get their feet under the table and start delivering results, actually you may still be underwater on that investment. And although a good advisor can present and sort of normalize that to a buyer, it's that little bit less appealing, a little bit an extra conversation that needs to explain what's going on here. It's not helpful. Professionalising the accounting functions. So lots of small businesses got perfectly adequate accounting functions. Serves the day-to-day job, but is it up to scratch for sort of a corporate buyer or private equity buyer who might be expecting monthly management accounts with sort of balance sheets and cash flows? Actually looking to start to introduce that means that you've got a longer run of good data set for a buyer to assess and look at. Corporatizing the business. So, and by this, and as I say, I apologise for the word, I don't think it's real, but think about what a large corporate would do. All the T's will be crossed, I's will be dotted, on all the sort of legal paperwork and other bits and pieces like that. So, your contracts up to date for maybe your leasehold, all staff contracts up to date. What about customer contracts, which also links to quality of earnings? Spend that time, absolutely finessing all those areas. And a sensible profit and loss, what do I mean by that? So I'll just use an example from back when, in my days as an auditor, sort of once looking at an overhead base on a company and asked, well, why is travel and expenses increased by £65,000 year on year? And the explanation was, oh, that's the managing director's wife's Maserati. Behaviour like that is not uncommon in smaller businesses, but it doesn't help in terms of selling. So the further out you start to plan and prepare, the cleaner your numbers can be, the smoother your process is likely to be. So looking at routes to market, as I say, 3 key ones. So trade, that's selling to not necessarily a competitor, but often a competitor. Pros here, so generally a trade buyer will be sitting on the cash. They won't have to go to investors to raise the money to buy you. They might still go to a bank, so it's not a sort of slam dunk, but it can be a little bit easier. If they're in your sector, they're likely to understand your market better, so they'll understand your business more quickly, and they'll understand where they can create synergies in your business, which will appeal to them. Cons, so trade secrets. Well, if you think about it, not every deal will complete. So if you've gone quite a long way down the road with a buyer who's one of your key competitors, you know, they've seen everything that's in your box of secrets, and then, you know, pull out of a transaction, maybe for perfectly legitimate reasons. But of course, you know, your trade secrets, although we try to protect them via NDAs and so on and so forth, they are now known, which is a risk, you know, a good advisor can help you to manage. They don't have to buy. You know, if you're an engineering firm buying another engineering firm, your day job is engineering. It's not buying other businesses. You might be acquisitive, you might want to grow via acquisition, but it's not necessarily, you know, central to what you need to do. And it can be slightly harder to identify a buyer. There's far more buyers in trade, but actually identifying the right ones and getting in touch with and in dialogue with the right stakeholder, the right decision maker, can be quite tricky. Again, a good advisor can help through that path. Private equity then, selling to investors, so much easier to identify buyers. You know, a good advisor will know most of the private equity network already. Often when we have an initial meeting with a prospective client, we can sort of immediately think of 4 or 5 private equity houses that, you know, might be interested in that particular opportunity. They have to buy companies. Their MO is to, you know, invest their investors' money to grow that. So, and they do that by acquiring companies. So they're although they might not know your sector, they are motivated to get money out of the door. Because they're buying and selling companies all the time, you know, this is sort of second nature to them. So the process may be far more streamlined, and also, you know, they'll actually look for this sort of a pro and a con. They generally can't run the business themselves. If you're looking to stay, that's great. They'd love for you to stay and carry on running your business, or they might look to back a management buyout, in which case you need a strong tier 2 management to effect that. Downside, so more so than with trade, they might look to defer some of the consideration, ask you to leave loan notes, or you know, there might be an earn-out sort of structure, so you might be leaving some value on the balance sheet. And perhaps unfairly, they're sort of seen as a bit of a tough choice. You know, they're going to beat you up over price, and you know, they're going to asset strip your business. I think that's a very unfair assessment, and a bit of a hang-up from the 80s and 90s. You know, there are now many private equity firms, and so, you know, it's fairly easy to find one that's quite user-friendly. Finally, then, employee ownership trusts. So this is literally selling the business to your staff. So the key pro to that, we haven't got to muck around with a buyer search. That's sort of done for you. You get to preserve your legacy, be that what the business does, its business name, and of course the staff. Staff are secure in their roles because they're taking over the business. And then a small pro, you might say, is selling tax-free, and that sort of compares with trade and private equity, where you'll get your 10% entrepreneurs relief exit up to your first £1 million in lifetime allowance. After that, it's at 20%, but note, it has been in the news a lot lately that the headline rate for capital gains tax may increase substantially, potentially from the 20% up to the income tax rate, which could be as bad as 45%. So, you know, you do need to think and take the right advice in terms of, you know, your tax hit on selling your business, whichever route you take. Cons of employee ownership trusts: you will get less cash out generally on day one. You know, you're only able to use cash on the balance sheet and some bank debt, so it's not quite as good, albeit the balance then sits on the balance sheet and paying you a coupon. So if you have faith that your business will continue, then that's actually quite a strong option. And, you know, clearly you will not be running the business, you've stepped away, so you do need the strong tier 2 management to take over from you. So we move on to the process then, and the 3 phases. So marketing phase, this is where your advisors will come in and they will initiate buyer searches. If you're going down the trade or private equity route, they'll make contact with those buyers. Initially, they'll want to send some high-level information that outlines the opportunity. That's generally in a teaser document. No names are named, so it's an anonymous part of the process. Once they're engaged, we'll sign up to a non-disclosure agreement and share the information memorandum, which your advisors will prepare. That is a detailed selling document that really lifts the lid on everything about the business. From there, likely to be meetings, hopefully, and it's a case then of receiving offers, which your advisor will review and advise on. And ultimately, then it's reaching point of signing heads of terms of your agreed offer. From where you'll move on to financial due diligence. And a bit like Stuart was saying earlier, key point here is preparation. The more time and effort we can put in here, and again, hopefully your advisor should be able to help you with this, get everything in order, get the documentation ready. So that will include things like management accounts, statutory accounts, other accounting records supporting the numbers within those, forecast budgets, so on and so forth. All of this is likely to sit in a data room, usually hosted by the seller's lawyers. But during this, your advisor should be supporting you through the process, and particularly because it is a very intense period. You're there trying to run the business and keep the lights on, keep the ship pointing in the right direction. Meanwhile, you've got these guys coming in doing FDD on your business. It's very disruptive. It's very disruptive, and to the greater extent that your advisors can assist you, you'll be able to keep on the straight and narrow. Once we've gone through financial due diligence, hopefully that's gone well, we'll move on to completion. And here is where your advisors and your lawyers will really work together to get us through all the way to completion. So a lot of hand-holding of the sellers. Generally, sellers haven't done a transaction like this, and so will be less familiar with this stage. Your advisors should be ensuring that the legal documents, which are sort of full of legalese and cleverness, reflect the commercial terms that were agreed as part of the offer. There's then a lot of project management to ensure that the deal basically is driven towards completion, at which point all parties sign, and that then is your deal done, and it's all congratulations all round. So I was just going to briefly touch then on choosing the right advisors. My advice is the more advisors that you can sort of see and speak to, and the earlier the better. You want someone with quite a hands-on approach. Often, some of the bigger firms you might speak to will sort of at the sales pitch meeting will sort of turn up and here's the partner and it all looks very impressive. But will you see that partner again before the completion meeting? My advice is certainly try and ensure that the team that you meet, the team that will be dealing with your transaction, you need to be able to build up a rapport and trust with your advisors. You're going to be working with them for many months. They are handling arguably the biggest transaction you may have ever undertaken in your life. Can you get on with them? Can you trust them? Do they have the right experience, of course? And so, to ascertain all of that, it's about meeting these advisors. I appreciate face-to-face right now, not really possible. Do it over Zoom, or come the new year, the more you meet face-to-face, and start early so that you've got the right advisors in place before you kick off your sales process. And with that, I shall hand back to Zafar. Thank you very much.
Thank you very much, Adrian and Stuart. Some very sort of insightful points that you provided there. I've got a question that's come through for you, Stuart. And it's been asked, what are some of the factors that will affect price at DD and disclosure stage? You mentioned there was a relationship between price and some of the factors that you might need to disclose.
Yeah, so, well, how long's a piece of string, really? I mean, in my experience of transactions, I identified a number of issues. I mean, one of the key areas is if the property has leasehold property, for example. Most leases will contain strong landlord-friendly repairing obligations and yielding up provisions, which means that you've got to hand the lease back in a certain state and condition of repair at the end of the term. Now, if you're halfway through a lease period at the point of sale, a buyer is going to be interested to understand whether or not there's accounting and financial provision for what that liability could look like. And if they engage a surveyor to go and look at those properties as part of the due diligence stage, and they identify that there is a potential liability in terms of the amount that could be due and payable, they will want to share that pain and therefore reduce the sale price. Issues with regards to change of control provisions. If you're a business that relies on a handful of contracts that are a lot of customer contracts that mean that you deliver your your services or your products over a period of time, quite often those contracts will contain a provision if the contract is going to be if this business is going to be sold or more than 51% of the shares are going to be transferred, then the customer has the ability to terminate that agreement, and of course that can have a material impact on financial performance, and again a price can be renegotiated. And then there's errors really. I mean, there could be identified in the financial due diligence stage that perhaps the payroll and the tax assessments haven't been done quite correctly, or there's an issue around how a particular financial transaction was treated from a tax perspective. And therefore, once that becomes quantifiable, again, a buyer will want to talk about the fact that they shouldn't be paying for that. So, as Adrian makes the point, if you can start the process as early as possible, you can identify these issues. And once you've identified the issues, you can then work out how you're going to solve the problem. So that when you do get to a point where you're presenting this information, you're not just presenting a problem, you're presenting the history and how you've resolved it, and therefore maximising what you're entitled to on completion in terms of the sale price.
Thanks, Stuart. Adrian, I've got one for you. Given what's happening in the global economy with the pandemic, should I delay the sale of my business in the context of sort of lockdown, and particularly the second lockdown?
Yeah, sure. I guess there's two answers to that. In terms of the wider pandemic, if your business is suffering quite badly as a result of the pandemic, but you can see a way through, maybe you've taken CBILS funding, bounce back funding, whatever it might be, trimmed costs, taken furlough, and so on and so forth. So you're confident that you'll reach the other side. Then at that point, you might consider delaying a sale process until your revenues and your performance are back to a level, closer to deliver a value closer to that which you would accept. That's a very personal decision. It might be that due to this pandemic, you've decided that you'd rather spend more time with the family. Whether you want to spend less time with the family, I don't know. But in other words, your business might not be worth half what it was 12 months ago. If that's still enough for you, then press on. If it's not, and you can see a way through back to the value from 12 months ago, maybe sit tight and carry on. But you can still start the preparation at this stage and start getting ready. And in fact, if you are struggling, revenue-wise or cost-wise because of COVID, actually all the more reason to do so. In terms of where we are with lockdowns, my view is that doesn't impact at all. We've a number of deals on at the moment. Things are taking longer, certainly, but deals aren't going away. I think if you're, lockdown doesn't stop you from starting to prepare a sale. It doesn't stop you from starting to meet advisors and lawyers. And even if you're quite a long way through a sales process, actually, most deals can be done remotely. All the deals I'm working on at the moment, and some even in the States, no one's met each other. It's sort of being done remotely, which seems a bit odd, but actually it's perfectly achievable. And so, certainly from the point of the new lockdown, I see no reason to delay for that. I think the only issue around timing is more a commercial one. And I guess on top of all of that, as an umbrella view, as I noted earlier, if you're worried about what your tax bill might be on selling, then certainly don't delay at the moment, because there is still just about time to get out before a possible change in CGT rate. So yeah, definitely consider your options.
Thank you very much, Adrian. Stuart, we've been asked a question around insuring against breach of warranty and indemnities. Is it possible to insure against those elements?
In a word, yes. It depends. The cost associated with obtaining insurance against a breach of indemnity or warranty can be very expensive. It can also be expensive not just because of the premium, but you are effectively going through a secondary due diligence exercise, because the insurers, more often than not, will appoint their own advisors to make sure that they're happy with the state and condition, for want of a better phrase, of the business from a governance and DD footing. So the cost associated with negotiating the terms of that policy as well can be expensive. It's not the sort of thing that you can buy off of a website and hope it covers every eventuality. It's a complex agreement. It's very prevalent in the US, it's very prevalent in Canada, but generally when you get to a deal size of around the sort of north of 20 million, the premiums are, as I say, quite expensive. There's also issues around COVID-19 related insured risks or impacts. So the short answer is yes, you can. The more sophisticated answer is it really depends on value, your business, what the potential liabilities are or could be, and whether or not at the end of analysing that with a broker really gives you the level of protection that you want it to have in regard to the premium and cost associated with obtaining it on day one. I think I've answered that question.
Thanks. For you, Adrian, I know you mentioned there's a sort of a 6 month to 2 year kind of preparation phase as one goes into a transaction. But in practice, how long does a sort of typical sales process take? From preparation and going out there, pitching investors and closing a deal.
Yeah, sure. I guess at the moment it varies, and as I noted, it's taking longer. Whilst you do see in the news some very big transactions almost happen over a weekend. That's much more sort of for public companies where that happens. Generally, with a private company sale, I would have said before COVID, you were probably looking on average 4 to 6 months, something like that, to from the point of initiating the sale process. So we've done the preparation and we're moving into the sale process itself now. That certainly has slowed down, although there's still plenty of buyers out there, still plenty of cash out there. We're just a little bit more cautious, spending a little bit more time getting to understand businesses, getting to also understand whether there is an impact from COVID and what that looks like going forward. So I would probably say you might be looking at an average around 9 months at the moment, but there's still plenty that are happening sooner than that. So, and again, I suppose back to my point around preparation being key. The more preparation you've done, and the more marketable, therefore, that your business is, the quicker a sale will be, even despite the pressures and the hurdles that have come because of the pandemic. But yeah, I'd say at the moment 6 to 9 months probably is average.
Thanks, Adrian. I think we are sort of coming up to the end of our allocated times. It's probably a good time for us to start wrapping things up. Thank you very much to Stuart and Adrian for joining us today and providing us with some very insightful comments and nuggets of knowledge. And thank you very much to everyone in the audience for joining us as well. We hope you found it helpful and insightful, and hopefully gave you a bit of a sense of what it means to sell your business in practice. We have quite a few other questions that have come through the chat function, but unfortunately we don't have the time to sort of deal with everything today. But I will make sure that either myself, Stuart, or Adrian reach out to you direct to have a chat with you about those queries. if you have any other sort of questions or thoughts or insights in the meantime, please feel free to get in touch with any of us. Our details are up on the screen, always up for a chat whenever you'd like. In the meantime, do follow us on LinkedIn and social media. We will be announcing our next webinar, which is meant to happen on the 26th of November. We're going to be exploring another form of exit in the context of a solvent winding up. So that should be quite an interesting topic and discussion on the day. So for now, thank you from myself, Stuart, and Adrian. Do stay safe, and goodbye for now.
Sure.
Bye.